The story of the U.S. stock market and the upcoming presidential election goes far beyond politics. Let's explore the various risks facing the market right now and how they all interconnect. Starting with the big picture, the U.S. stock market has been experiencing increased volatility lately, and one key indicator is catching everyone's attention: the CBOE Volatility Index, or VIX. Often called the fear gauge of the market, the VIX measures expected market volatility. Currently, the VIX is hovering around 20, significantly higher than its 2024 average of 14.8. This tells us that investors are more nervous than they've been for most of the year. But why? Let's break it down. First, let's talk about the elephant in the room, the upcoming U.S. presidential election. Historically, the VIX tends to rise by about 25% between July and November in election years. This makes sense because investors are trying to anticipate how each candidate's policies might affect the market. The upcoming televised debate between Kamala Harris and Donald Trump is particularly significant. These debates can have real impacts on market sentiment. For example, after a June debate in which President Joe Biden's performance was seen as underwhelming, we saw rallies in parts of the market that might benefit from Trump's policies, such as small-cap stocks and energy shares. However, it's important to note that these Trump trades have since cooled off. With Harris replacing Biden as the Democratic contender and the race tightening, the market is in a state of uncertainty. This upcoming debate could provide crucial clues about the potential winner, which has significant implications for market direction and policy expectations. But the election is just one piece of a larger puzzle. The U.S. economy is sending mixed signals, and this is contributing to market nervousness. We've recently had 2 consecutive underwhelming jobs reports. This is significant because employment numbers are a key indicator of economic health. When job growth slows, it can signal that the economy is cooling off, which isn't great news for stocks. This economic uncertainty ties directly into another major factor: Federal Reserve policy. The big question on everyone's mind is how deeply the Fed will need to cut interest rates. Lower rates can stimulate the economy, but they're also a sign that the Fed thinks the economy needs help. It's a delicate balance, and the uncertainty around future Fed actions adds to market volatility. Now, let's look at how all these factors are playing out in the market. Despite these concerns, the S&P 500 is still up nearly 15% this year, which is impressive given the circumstances. However, we recently saw the worst weekly percentage loss since March 2023. This volatility reflects the market's struggle to price in all these uncertainties. This uncertainty is driving increased demand for portfolio hedging. Essentially, investors are looking for ways to protect themselves against potential market swings. It's like buying insurance for your stocks. Interestingly, when we look at VIX futures, which are contracts that bet on future volatility, we see something unusual this year. In previous election years, there was a significant gap between the VIX futures for different months around the election. This year, that gap is much smaller. This suggests that investors are already pricing in a high level of uncertainty, not just for the election, but for the months surrounding it as well. Let's dig deeper into some specific policy areas that investors are watching closely. These could have significant implications for different sectors of the market. Trump has promised lower corporate taxes, which could boost businesses across the board. Harris, on the other hand, plans to raise the corporate tax rate to 28% from 21%, which could impact corporate profits. Trump has also indicated a tougher stance on trade and tariffs. If trade tensions increase, this could affect international businesses and potentially lead to market volatility. Harris is expected to continue many of Biden's clean energy initiatives. This could benefit solar companies and other renewable energy stocks, although these sectors have been facing headwinds from high interest rates. Harris also plans to lower drug prices, which could weigh on healthcare stocks, particularly pharmaceutical companies. These policy differences explain why certain sectors might react differently depending on election outcomes, and why investors are closely watching the polls and debates. So, with all this uncertainty, how are investors responding? Some analysts, like those at Societe Generale, advise investors to stay hedged for the next 3 to 6 months. They're warning about possible volatility from economic surprises and geopolitical factors, including the U.S. election. However, it's not all doom and gloom. Some experts point out that stocks have performed well under both Trump and Biden administrations. Seth Hickel, a managing partner at Mindset Wealth Management, notes that with Harris's policies likely to be similar to Biden's, either candidate's victory doesn't present a major challenge to investors. As we wrap up, let's recap the key points. 1. The upcoming U.S. election is a significant factor in current market volatility, but it's not the only one. 2. Economic uncertainty and Federal Reserve policy are major concerns intertwined with election worries. 3. Different market sectors may be impacted differently based on election outcomes. 4. Despite these challenges, the S&P 500 has shown resilience, though recent volatility highlights ongoing concerns. 5. Many investors are seeking ways to hedge their portfolios against potential volatility. Remember, investing is always a balance of risk and reward. The current market conditions present both challenges and opportunities. The key is to stay informed, think long-term, and make decisions based on your individual financial goals and risk tolerance. That's all for today, folks. We've covered a lot of ground, from election impacts to economic indicators, and how they all interconnect to shape our current market landscape. I hope this overview has given you a clearer picture of the complex factors at play in the U.S. stock market right now. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell to stay up to date with all our market insights. And let us know in the comments, how are you approaching your investments in light of these market conditions? Until next time, happy investing, everyone.